Welcome back to Investing Talk Podcast. Today, we're doing a really focused analysis on Nebius Group. They're obviously a huge player in AI infrastructure. And the core question for you, our listener, is pretty straightforward. Is Nebius Group a good buy right now? We're going to unpack the financials, look at what the charts are saying, and cover the key events coming up in the next few months to really try and answer that. Oh, and before we jump in, please do subscribe, like the analysis if you find it useful, and drop a comment. Seriously, if there's a company you want us to analyze next, let us know below.
Absolutely. Nebius Group is, well, it's certainly drawing a lot of market attention. And you can see why, given their position right in the middle of this global AI build-out, we'll be synthesizing quite a bit of data here. Profitability, their competitive strengths, and the technicals, which are looking pretty bullish at the moment. Hashtag the core foundation, unmatched profitability.
Okay, let's start with the fundamentals then, because this is where the Nebius Group story gets genuinely wild. When you look at these core numbers, they almost seem, well, too good to be true compared to what you normally see in tech. What really stands out to you first?
It's the sheer profitability. I mean, trailing 12-month revenue is reported at $249.3 million. Okay, solid. But the net income, it's nearly the same, at $243.5 million. That implies an incredibly minimal cost structure relative to their sales.
The number feels like an understatement there. That puts their net income margin near 98%. Honestly, that figure alone makes me pause. We're talking AI infrastructure, GPUs, data centers, power, cooling. It's famously capital intensive.
Yep.
How is a 98% margin even feasible here? Is this some kind of accounting trick, or is there a real structural reason?
That's absolutely the right question to ask, and it points to their structural advantage. You know, typical tech margins might be, 15% to 35%? The way Nebius Group achieves this phenomenal 98%, seems rooted directly in their operational model. They are, for all intents and purposes, vertically integrated. Their full-stack solution, which we'll break down more in a second, means they heavily use their own infrastructure, their own software. This minimizes cost of goods sold and slashes those outsourcing fees that hit competitors hard. It really allows for what you have to call, well, best-in-class operational efficiency.
Okay, so that integrated ecosystem isn't just marketing talk. It's actually the engine driving these profits by keeping costs internal.
Precisely. And that extreme profitability, it flows right through to a rock-solid balance sheet. You've got a $29.13 billion market cap, clearly supported by strong cash flow. And based purely on that revenue-to-income conversion, you'd infer pretty low underlying debt. It gives them a very flexible foundation to innovate from. I do need to add a quick but important note on transparency here for you listening regarding our sources.
Yes, good point. For clarity.
The financial figures we're discussing, they come from consolidated secondary reports based on what the company has disclosed. Specific official filings like, say, detailed debt ratios, precise cash flow statements, or the official SEC 10Q or 10K forms for Nebius Group, those weren't publicly available as of October 17th, 2025. So we're working with the high integrity implied by these reported conversion figures themselves. Understood. That's important context. Now, looking at volatility, their beta is 1.1 In a high-growth area like this, what does that number suggest about investor confidence?
A beta of 1.1 points to pretty robust confidence, actually, and relative stability. For anyone less familiar, beta just measures how much a stock moves compared to the overall market. A lot of high-growth AI firms, especially those maybe focused purely on hardware or very cutting-edge tech, they often have betas over 1.5. That means big price swings. Nebius Group's more moderate 1.1 it suggests the market sees that fundamental profitability floor we just discussed as a real source of resilience. It kind of reduces the fear of dramatic sell-offs. Hashtag competitive moat and capital strength.
All right, let's connect that incredible profitability back to the competition. What exactly is this full-stack moat that's supposedly protecting those 98% margins?
Yeah, the competitive edge isn't just about having powerful chips. It's the whole ecosystem. Nebius Group leads because they offer these comprehensive full-stack solutions. So yes, they provide the large-scale GPU clusters and their own proprietary cloud services. But crucially, they also own other key parts of the value chain, like, for example, specialized services data labeling through Toloka, or developing talent via their edtech arm, 1010. They even have autonomous platforms with Avride competitors. They often focus on just one piece, hardware, cloud, maybe services, and then they have to pay high margins to partners for the rest. Nebius Group aims to keep that whole revenue stream inside.
So they're essentially controlling the quality, the cost, and the client's whole journey all at once. And this isn't just in one place, right? It's global.
Absolutely. Their leadership spans key geographies, the Netherlands, broader Europe, North America, and Israel. That diversification provides a buffer against, say, local economic issues or regulatory changes, makes the revenue inherently more stable.
And they're clearly not standing still. They just rolled out Nebius AI Cloud 3.0 Aether this October. Feels like a direct play for those high-end enterprise AI clients.
It's a critical launch, yes. Really focused on the enterprise-grade security and scalability needed for big AI projects. What's interesting, though, is how the market reacted to that recent huge partnership they announced. A massive $17.4 billion infrastructure deal with Microsoft for AI services. Yet, right after the announcement, the stock actually dipped temporarily, about 7.3%.
That temporary drop is interesting. Why would news of a giant partnership cause a sell-off, even a brief one? Worries about execution, maybe, or the impact on those crazy margins?
It was likely a mix of things, some profit-taking after the news hit, perhaps, or maybe some initial investor worry that the structure of such a large deal might dilute those ultra-high margins we talked about. But the stock bounced back pretty quickly. That suggests the market decided the sheer scale and, importantly, the validation from a partner like Microsoft. Well, that it far outweighs any temporary margin questions.
Makes sense. Now, how are they funding all this growth? We saw some pretty hefty capital raises lately.
We did indeed. Over just the last 3 months, they pulled in a total of $4.2 billion in aggregate gross proceeds from capital raises. This came from a mix of issuing public Class A shares and also convertible senior notes. For you listening, convertible notes are basically debt that investors can swap for shares later if the stock price goes up. It's a smart way to raise funds, often with lower initial interest costs, because investors are betting on that future stock appreciation. So that $4.2 billion injection, it creates this massive war chest for more strategic moves, expansion.
Yeah.
It really signals deep investor confidence in their growth path. Hashtag technical signals and analyst sentiment.
Okay, let's pivot now from the solid fundamentals to the technical side of things. What's the chart telling us about how investors are behaving price-wise?
Technically, the picture looks unequivocally bullish right now. The stock's been carving out a pattern of higher lows, trading nicely inside a strong rising channel. We've already seen the price jump nearly 16% in just the last couple of weeks. That shows significant buying pressure.
That's some serious momentum. Technical analysis often gives pretty aggressive forecasts based on that kind of action. What sort of upside are the models pointing to near term?
The technical forecasts are projecting a, well, quite impressive 84.75% upside potential over the next 3 months. Now, that would put the expected trading range somewhere between $90.74 and $118.23 by January 2026. Of course, that relies on this bullish momentum continuing.
Right, so for investors maybe looking at entry points or where to set stop losses, what are the key support and resistance levels to watch right now?
Okay, short-term support looks pretty solid, down at $49.11. That's kind of the floor for now. Short-term resistance is currently up at $52.15. And crucially, the stock is trading comfortably above its long-term moving average, which sits at $50.16. Staying above that average helps confirm the longer-term bullish trend is still valid despite any day-to-day noise.
And what about momentum itself? What are the indicators showing there?
The MACD, that's the moving average convergence divergence indicator, is showing strong, positive, bullish momentum. Basically, when the MACD is strong and positive like this, it suggests buying pressure is actually accelerating. Plus, we're seeing something interesting, falling volume on the minor price dips. That suggests that when the price pulls back a bit, sellers aren't really eager to jump out. It hints that larger institutions might be accumulating shares quietly, which usually reduces the chance of sharp sell-offs later.
Okay, so with that strong technical setup, it probably doesn't surprise anyone that the analysts are feeling pretty positive too. What's the consensus rating, and how aggressive are their targets?
The analyst consensus is currently a strong buy, and they've recently boosted their average target price significantly up 32% to a rather aggressive $144.64 as of October 17th.
Wow, $144.64. That's way above even that 3-month technical forecast we just heard. Doesn't a target like that already price in, well, basically all the good news and maybe even some of those rumors we're about to get into? Is it realistic without absolutely perfect execution?
That's a really sharp point and highlights a key challenge for this bullish case. That elevated target implies analysts aren't just valuing the current amazing profitability, they're applying a hefty premium based on expected market share gains and assuming several high-impact catalysts actually happen. It represents, frankly, extreme optimism. It suggests the valuation hinges heavily on Nebius Group not just growing, but doing so while maintaining something close to that incredible 98% margin profile, even as they push into potentially more competitive service areas, hashtag upcoming catalysts and potential risks.
All right, this brings us to the calendar. For anyone thinking about timing, what are the specific concrete events coming up in the next 3 months that could really move the stock?
The single most critical one is the Q3 earnings release and their updated guidance for the future. The key date we're tracking for that is November 6th, 2025. Expectations are high, obviously, for strong year-over-year growth, thanks to all the AI infrastructure demand. If they deliver a beat and offer strong guidance, especially if those 98% margins somehow hold, that could be the main driver towards those technical targets.
Okay, earnings on November 6th. Anything else on the radar maybe influencing how big institutions trade the stock?
Yes, later in November, specifically November 29th, 2025, that's a MAVITA date for ETF rebalancing. This is when big exchange-traded funds that track tech on cloud indexes have to adjust their holdings, since Nebius Group is a major player in that space. This rebalancing can often trigger automatic buying from these large funds, pushing the price up almost regardless of specific company news that day. We also expect, just generally, more announcements about new market entries or maybe significant commercial deals linked to that new Nebius AI Cloud 3.0 platform.
Got it. So beyond those confirmed dates and likely announcements, what kind of speculative stuff, what rumors are swirling around Nebius Group right now?
Well, there's definitely some unconfirmed market chatter pointing to potentially high-impact developments. We're hearing whispers about possible M&A activity, maybe targeting smaller companies in areas like edge AI hardware, or perhaps MLOps. MLOps, that's machine learning operations. It's all about managing the life cycle of AI models effectively. Buying MLOps tech would further cement that full stack advantage we discussed. There were also persistent rumors about a potential joint innovation lab with Microsoft focusing specifically on secure AI cloud stuff. That would be a huge strategic win if true. And finally, there's ongoing speculation about landing potentially large new government contracts, maybe in the UK or the EU. That could be another significant driver.
Okay, any one of those rumors turning real could definitely help justify those high analyst targets, but we absolutely have to talk risks. Beyond just general tech sector volatility, what specific risks should investors keep a close eye on with Nebius Group?
Yeah, we need to look past the standard risks here. Sure, competition from the big cloud players, AWS, Azure, Google Cloud is always intense. But Nebius Group's main vulnerability, I think, is execution risk. Specifically, the risk tied to managing such rapid growth. They're raising billions, they're expanding globally at an aggressive pace. Trying to sustain anything close to a 98% margin while scaling operations that fast, entering new countries, integrating huge deals like the Microsoft one, that presents an enormous management and operational challenge. Any significant hiccup in their infrastructure rollout, or if they fail to quickly generate returns on that newly raised capital, that could really hit investor sentiment hard. Hashtag tag outro.
So, wrapping this all up, what does it mean for you? We've looked at a company with profitability that's, frankly, almost off the charts. A dominant, diversified market position built on that full-stack approach. Billions in fresh capital and technical signals. Strongly bullish, backed up by analysts predicting major upside.
The overall take is definitely strongly bullish. We'd reiterate an overall bullish rating here, maybe a 9 out of 10. Nebius Group NV looks positioned as both potentially an attractive, aggressive short-term trade, riding these upcoming catalysts, and potentially a compelling long-term compounder, anchored fundamentally by that sector leadership and, crucially, that near-unmatched profitability.
Yeah, it feels like many of the pieces are definitely in place for a significant move higher.
Yes, they are. But this leads us to the final provocative question for you to really think about. Given that a good chunk of that forecasted upside, especially those really high analyst targets, seems to rely heavily on speculative things happening, like M&A or landing big government deals, is the current technical target range maybe already baking in too much optimism, too much hope? Or does the sustainability of that incredible fundamental profitability of the mechanics behind those 98% margins provide enough of a safety net? Enough operational strength to protect the downside, even if those more speculative rumors don't actually pan out. That tension between the solid fundamental floor and the more aggressive speculative potential, that's really the core decision you need to weigh.